They chose the worst possible moment. They waited for volume to disappear. They waited for liquidity to dry up. They waited until everyone was looking away. And then, in the final hours of the final trading day of the year, they struck with surgical precision. Look at your screen right now. What you're seeing is total devastation. Silver has crashed to $70.50. We were trading at $77 just yesterday. That's a $6.50 bloodbath in a single session. Your portfolio is drowning in red. Every refresh shows deeper losses. And if you're feeling sick to your stomach right now, you're not alone. Thousands of investors are watching weeks of gains vanish into thin air. But what if I told you that this massive price movement has almost nothing to do with the actual value of silver? What if the real story isn't about weakness in precious metals, but about something far more mechanical, far more predictable, and far more temporary than you think? The truth is, we're watching a textbook example of what happens when bureaucratic rules collide with thin market conditions on December 31st. This isn't silver losing its shine. This is balance sheets, capital requirements, and regulatory frameworks forcing the world's largest financial institutions to make very specific moves at very specific times. Understanding this difference could be the most valuable thing you learn before we enter 2026. Because while everyone else is panicking about the price drop, the smart money is already positioning for what comes next. And what comes next on January 10th, when markets fully reopen, could be the most explosive silver rally we've seen in decades. Let me show you what's really happening, why the timing matters, and why this apparent disaster is actually setting up the opportunity of the year. If you run a major bank, December 31st isn't just another trading day. It's the day when regulators take their annual snapshot of your entire balance sheet. Every asset you're holding, every position you've taken, every bit of risk exposure gets frozen in time at midnight tonight. And that snapshot determines something crucial: your capital requirements for the entire next year. The banking world operates under the Basel III framework. Within that framework sits the GSIB score, the Global Systemically Important Bank Score. This number matters more than almost anything else to bank executives. A higher score means setting aside billions, sometimes tens of billions, in additional capital reserves. Money that could generate profit suddenly sits idle, doing nothing but satisfying regulatory requirements. What affects this score? Volatility, risk exposure, the kinds of assets sitting on your books when regulators come knocking, and precious metals count as highly volatile assets. They move fast, swing hard, and from a regulatory perspective, holding large silver positions increases your risk profile substantially. So if you're the chief risk officer at a massive institution and you know regulators will take their picture in a few hours, what's your move? You do exactly what we're seeing right now. You sell, you dump gold holdings, you unload silver contracts, you liquidate everything possible into the one asset class that actually lowers your risk score: cold, hard cash. This explains the carnage across your screen. Gold down $76, trading around $2,294. Silver fell even harder because it's a smaller market with higher volatility. When gold catches a cold, silver gets pneumonia. That's the relationship. But here's the critical insight that changes everything. This selling pressure has an expiration date. Literally. At midnight tonight, the snapshot gets taken, books close, regulatory requirements get satisfied, and suddenly, there's no longer any reason to maintain defensive positioning. The pressure valve releases, forced liquidation ends, capital that fled the market can flow right back in. Look at how thin markets are today. Half the traders checked out mentally. They're with family, traveling, done for the year. Institutional desks run skeleton crews. When you try to move large positions into thin markets, price impact gets magnified exponentially. A bank selling 5,000 contracts might drop the price 50 cents. 10,000 contracts could push it down $2. They're not trying to get the best price, they're trying to meet a deadline. Speed matters more than efficiency. This creates cascading effects where each wave of selling triggers the next. Technical stops get hit, algorithms trigger, momentum players pile on. It's a self-reinforcing cycle that feeds on itself until all the forced sellers are exhausted. But here's what most people miss. This volume vacuum works both ways. Just as selling pressure gets amplified on the way down, buying pressure gets amplified on the way up. When fresh capital enters a thin market, prices can explode higher just as violently as they collapsed. History shows this pattern repeats with mechanical consistency. Banks sell on December 31st to clean up their balance sheets. Then they buy back those same positions around January 10th when the New Year's trading fully resumes and the rules reset. What you're witnessing right now is simply the sell side of that trade. The buy side comes in about 10 days when all that institutional money returns to the market. There's another layer making this selling even more intense: the dollar. As banks convert their asset holdings into cash, the demand for dollars spikes dramatically. Every major financial institution around the globe is trying to do the same thing at the same time: get dollars onto their balance sheets. This creates a temporary dollar shortage in the banking system. When demand surges while supply stays constant, the dollar index rallies. And we're seeing that today. It's not because the American economy suddenly became super robust, but because there's a scramble for dollar liquidity to meet these year-end requirements. Now, when the dollar rallies, it acts like a wrecking ball on commodity prices. Oil, copper, agricultural products, and precious metals all get crushed. A stronger dollar makes these assets more expensive for international buyers, which reduces demand and pushes prices lower. It's just a mechanical process, but this dollar spike is artificial. It's manufactured by regulatory timing, not by underlying economic fundamentals. The Federal Reserve understands this. They monitor these patterns every single December and have tools to address it: repo markets, overnight lending facilities, and liquidity injections. When the Fed sees the banking system needs dollars for these regulatory requirements, they provide those dollars. And when that fresh liquidity enters the system, the artificial dollar shortage disappears. Commodity prices then snap back to their fundamental values. That's the storm we're sitting in right now. It might look loud, violent, and terrifying on the charts, but it's temporary by design. While the paper price of silver crashes, something fascinating is happening in the physical market. Right now, if you check dealer websites, the spot price might show $70, $50. Theoretically, you should be able to buy physical silver eagles for maybe $74 after accounting for normal premiums. But that's not what you'll see. The premiums have actually expanded today. Yesterday, dealers were charging around $10 over spot. Today, some are charging $12 to $15 over spot. So why would premiums increase when the spot price crashes? Because dealers understand this drop is a paper phenomenon. It's happening in futures markets, in derivative contracts, within the financial system. But in the real world, where actual physical metal changes hands, there's no panic. Nobody is lining up at coin shops to dump their silver. Nobody is calling dealers desperate to sell. The physical market remains tight, so dealers face a dilemma. If they lower their prices to match the spot price and sell you a coin for $74 today, but then the spot price bounces back to $78 on January 10th, they've lost money. They can't replace their inventory at the price they sold it to you. This disconnect between the spot price and the street price is one of the most reliable indicators that physical supply is still constrained. Paper markets can be manipulated. Physical markets reflect reality. From an industrial perspective, this gets really interesting. Imagine you're a procurement officer at a major electronics manufacturer. Your January budget is already set. You plan to buy silver at $77, and suddenly it's available for $70.50. Your reaction isn't to get upset, you're thrilled. This is an unexpected cost reduction. You are immediately putting in buy orders, using this dip to lower your annual average cost for raw materials. This industrial buying creates a natural floor. Silver can only drop so far before these industrial users step in and absorb all the available supply. We believe that floor is right around $70. Below that, the value proposition just becomes too compelling. Factories will clean out whatever physical inventory exists. Here's the key difference. When industrial users buy silver, that metal leaves the investment market permanently. It gets turned into solar panels, electrical contacts, medical devices. It gets consumed. It never comes back. While banks are dumping paper contracts to satisfy accounting rules, industry is taking physical metal off the table forever. This accelerates the underlying shortage, moving metal from weak hands to strong hands, from paper to physical, and from temporary holders to permanent consumers. There's one more dynamic worth understanding: the short squeeze reload. Earlier this week, some banks and hedge funds covered their short positions as prices rallied. They took losses and got out. But today, to smash prices back down, they likely re-entered those short positions. They sold new contracts, adding to the short side to create that downward pressure. What does this mean? They've put themselves right back into the trap they just escaped. They covered on Tuesday and then re-shorted on Wednesday. Come January 10th, When new capital enters and prices start rising again, they'll have to cover these fresh shorts at even higher prices than where they entered. They're kicking the can down the road, but the road slopes upward. Eventually, that can rolls back and hits them. Short interest in silver has been reloading all year. Every time they cover during rallies, they have to reshort during crashes to profit from the decline. But each cycle leaves them more exposed. At some point, covering becomes impossible without causing massive spikes. That's the squeeze everyone's waiting for. Today's action just added more fuel to that eventual fire. January 10th isn't just another trading day. It represents the arrival of fresh capital after the holiday break. Pension funds make their allocations. Endowments deploy their annual budgets. Managed money that's been sitting on the sidelines returns to active management. Billions flow into the markets during the second week of January. It's one of the most reliable seasonal patterns in finance. Right now, the markets are illiquid. There are no buyers. That's why selling pressure has such an outsized impact. But in just 10 days, the buyers return, volume returns, and capital returns. When that wall of money hits a market that's been artificially suppressed, the reversal can be violent. We could legitimately see silver jump from $70 back to $77 in a single session. That's a 10% move in one day. Think of it like a slingshot. The farther back you pull the band, the more energy you store. Right now, the price is being pulled back by regulatory selling and year-end mechanics, but the energy is building. When that tension releases, all that stored energy converts to upward momentum. By forcing prices down today, the market is essentially loading the slingshot for the January launch. From a chart perspective, this drop does create damage. We've broken below the $72 support that held for days. We've printed a large bearish candlestick on the daily time frame. Technical traders who don't understand the fundamental drivers will look at this pattern and calculate that the downtrend is initiated, momentum is broken, and it's time to sell. This creates secondary selling waves as algorithms trigger and momentum players pile on. Right now, we're testing $70. This level is genuinely important. $70 represents more than just a round number. It was resistance for an extended period. We spent weeks trying to break above it. We finally did. Now we're back testing it from above. This is a normal technical progression. Old resistance becomes new support. The question is whether the level holds. Looking at the volume data, something interesting emerges. Every time the price touches $70.50, we see absorption. Buying volume increases. Someone steps into the market at these levels, taking the other side of the trades. That's not the behavior of a market in genuine distress. That's the behavior of a market where informed buyers recognize value and accumulate positions while prices are temporarily depressed. Who are these buyers? Likely a mix of industrial users who need physical silver for manufacturing, long-term investors who understand the fundamental shortage, and contrarian traders who specialize in buying panic. These are strong hands. They're not over-leveraged. They're not forced to act. They're choosing to act because they see opportunity in the chaos. So what does the chart need to look like to confirm the bottom is in? First, we need to hold $70 on today's close. If we close above 70 despite all the pressure, that's a massive psychological victory. Second, we need a gap up on the morning of January 10th. If we open at $71 to $72, it confirms new buyers are entering at these levels. Third, we need to reclaim $73 within the first 2 weeks of January. That would prove the selling was an aberration, not a trend change. If we get all three, we're likely looking at a V-shaped recovery. We could be back at 77 by mid-January. We could even hit 82 by the end of the month. The speed of the recovery will match the speed of the decline. This is how liquidation events resolve. Fast down, fast up. The price action is violent in both directions because it's driven by liquidity, not fundamentals. As we look ahead, remember what's really happening in the macro environment. Central banks around the world are easing policy. Eastern powers are cutting rates. European powers are cutting rates. The global money supply is expanding. This liquidity is like water. It flows downhill and fills every crack in the system. Right now, it's temporarily flowing out of silver because of year-end dynamics. But in January, the tide turns. Liquidity floods back in. The global money supply chart points in one direction, up and to the right. Silver will follow because it has no choice. Monetary expansion always finds its way into real assets eventually. Whether the economy booms or busts, whether we get inflation or deflation, whether growth accelerates or decelerates, silver benefits. The only environment that hurts silver is stability. Does the current global situation look stable to you? You have financial capital, money in accounts, and emotional capital, your ability to handle stress and maintain discipline. Today, you spent significant emotional capital. Watching portfolio values drop is exhausting. It triggers anxiety. It makes you question your decisions. That's normal human psychology. But you need to recharge that emotional capital. The best way is by stepping away. Turn off the screens. Stop calculating the changes from the peak. It's not real unless you sell. Trust your original analysis. Why did you buy silver? For quick trading, or because you understand the monetary system faces mathematical challenges? If your analysis was based on long-term structural deficits and eventual changes in paper markets, nothing that happened today alters that analysis. The timeline might differ from your expectations, the path might be more volatile than you anticipated, but the direction remains the same. Don't let a one-day liquidity event change your long-term strategy. For silver to decline significantly, we'd need massive deflationary pressures where factories reduce operations, consumption drops, and the global economy slows substantially. Or we'd need the supply deficit to somehow resolve instantly. Neither scenario appears likely. If we did see deflationary pressures, governments would respond with monetary policy, increase the money supply, inject liquidity, and support economic activity. That monetary expansion would support commodity prices, including silver. Even challenging scenarios often support precious metals when you consider the policy responses. There's a limited, realistic path where silver loses significant value over extended periods. The mathematics just don't support it. The deficit is structural. Demand is established. Supply is constrained. Those fundamentals outweigh short-term price movements every single time. Major financial institutions use their year-end tools, thin liquidity, regulatory deadlines, and maximum uncertainty. And you maintained your position. You didn't sell at the lows. You didn't react emotionally. That makes you part of the patient capital. That makes you one of the few who understands the difference between price and value. As we enter the new year, you're positioned for what could be significant opportunities in the precious metals markets. The cumulative effect of years of supply deficits is approaching its mathematical endpoint. Shortages are becoming visible. Premiums are expanding. Physical markets are showing a disconnect from paper pricing. Something has to adjust. When it does, the price movements might not be gradual. They could be substantial. The numbers you see on the screen are just temporary quotes based on current liquidity. The metal in your possession or storage, that's tangible. That's what matters. Welcome to the year ahead. The setup is established. The pressure is at its maximum. Stay positioned. Stay patient. The pressure ends at year end. The opportunity begins when the market reopens. This content is for educational purposes only. Silver markets carry significant risk. Past performance doesn't guarantee future results. Consult qualified professionals before making financial decisions. Only allocate what you can afford to lose. Thanks for watching, and be sure to follow for more updates.